All right, let's get right into it. We hear about company profits all the time, right? It's always in the headlines. But is that really the whole story? Today, we're going to look beyond those big numbers to what truly keeps a company alive and kicking: cash.
So let me just pose a question. You see a company reporting record profits. Your first thought is probably, wow, they must be absolutely crushing it. But does being profitable automatically mean a company is healthy?
The answer is kind of surprising. It's not always a yes. A company can look great on paper, showing a huge profit, but still be on the brink of not being able to pay its bills. The real story, the unvarnished truth, is always in the cash.
And the tool that lets us see that truth? It's called the cash flow statement. It's all about following the money where it actually comes from and where it actually goes.
So what is this thing exactly? Well, think of it this way. It's a report that shows the real hard cash coming into and going out of a company over a certain amount of time. And honestly, the best way to think about it is like your own personal bank statement. It doesn't show promises or IOUs, just the money that has physically moved.
Now here's where it gets really neat. All the complicated things a company does with its money, it can all be boiled down and sorted into just three simple categories. Three main buckets, if you will.
And here they are. First up, you've got operations. That's the day-to-day stuff. Second is investing. This is about buying and selling things for the future. And third, you have financing, which is basically borrowing money and raising capital. Every single dollar fits into one of these three. Okay, let's break down the first one, which is arguably the most important of all: cash from operations. This is like the engine room of the entire company. Operations is all about the cash a company makes from its main business, what it was actually created to do. To bring it back to you and me, it's just like your paycheck minus all your living expenses, your rent, your groceries, your car payment. It's the cash that's left over from just doing your job.
So it's pretty straightforward. Cash comes in when they sell their products or services, and cash goes out when they have to pay for stuff like supplies, materials, and of course, paying all their employees. You really want to see this number be positive and consistently positive.
All right, on to our second bucket, cash from investing. This part of the statement tells us a totally different story. It's about how a company is planning and building for its future. Cash from investing is all about the money spent on or received from long-term assets. In your own life, this would be like buying a house or maybe investing in the stock market. You're putting cash out now, hoping for a bigger payoff down the road.
And you can see it's a two-way street. Cash flows in when a company sells off assets, like an old factory or some shares they owned in another company, and cash flows out when they buy new stuff, a new building, new equipment. It's really common to see a negative number here for a growing company, and that's not a bad thing. It just means they're investing in themselves.
And that leads us perfectly to our third and final category, cash from financing. Because if a company is spending more on investing than it's making from its operations, where does that extra cash come from? Well, this section tells us. This is all about the flow of money between a company, its owners, the shareholders, and its lenders, like the big banks. For us, this is just like taking out a car loan when you need a new ride, or, on the flip side, making those monthly payments to chip away at your student debt.
So, looking at the inflows, cash comes in when a company issues new stock or when it takes on new debt like a bond. The outflows, well, that's the money going back out to investors, either by paying dividends to shareholders or by paying back the money it borrowed.
Okay, so we've got our three pieces of the puzzle: operations, investing, and financing. Now we put them all together to see the company's full story for the period. Let's add it all up.
Let's walk through this super simple example. You start at the top with the cash from the main business, operations. Here, they brought in a positive $1 million. Awesome. But then they used $500,000 of that for investing, so that's $500,000 going out. And then they paid back some debt, so another $200,000 went out for financing. When you add those three numbers up, you get the final result, the company's net cash position. In this case, it's a positive $300,000. This is the bottom line. It tells you, plain and simple, whether the company's total cash in the bank went up or down.
And that right there is why this is so incredibly important. Smart investors check the cash flow statement to get the real story. Is the company making its own money, or is it just borrowing to stay afloat? Is it investing for the future? The cash flow statement doesn't lie.
At the end of the day, it really boils down to this. You probably heard the saying, profit is an opinion, but cash is a fact. And it is so true. So the next time you look at a company's report card, ask yourself, are you just going to look at the profits,
are you going to find out where the cash is?